In this presentation, we go over how supply enters the market, how supply leaves the market, how demand forms in practice, not theory, liquidity or the missing piece most people ignore, and finally, price being set at the margin. How supply enters the market, including minting, unlocks, emissions. Even when a crypto asset has a clearly defined maximum supply, new supply can still enter the market continuously. This is one of the most misunderstood dynamics in crypto and one of the most important for understanding price behavior. The first pathway is issuance through mining or validation rewards. In proof-of-work systems, new coins are minted as block rewards. In proof-of-stake systems, new tokens are often issued as staking rewards. In both cases, these tokens are not theoretical. They are paid to participants who must decide whether to hold or sell. If those participants regularly sell to cover costs or lock in returns, new supply steadily meets demand. The second pathway is token emissions tied to incentives. Many networks issue tokens to bootstrap activity, liquidity incentives, developer grants, ecosystem rewards. These emissions are often framed as growth investments, but from a market perspective, they are supply injections that need buyers to absorb them. Then also thirdly, there are vesting schedules and unlocks. Early contributors, investors, and foundations frequently receive tokens that unlock over time. On paper, these tokens already exist. In reality, they are invisible to the market until they unlock. When they do, effective supply can expand sharply, especially if holders choose to sell into liquid markets. This is why markets often react before unlock events. Price doesn't wait for supply to hit exchanges. It adjusts when participants anticipate that supply will become sellable. Another subtle factor is distribution concentration. If new supply flows primarily to participants with low holding conviction, such as miners, liquidity providers, or short-term funds, it is more likely to become active selling pressure. If it flows to long-term holders, the impact can be muted. The key takeaway is simple but critical. Fixed supply does not mean fixed selling pressure. Supply enters the market not all at once, but through predictable and sometimes underestimated channels. Understanding those channels helps explain why price can struggle even during periods of apparent growth and why timing matters as much as totals. How supply leaves the market: burns, lockups, inactivity. Supply doesn't just enter crypto markets, it can also leave them, at least economically. This side of the equation is discussed far less often, yet it plays a major role in shaping effective supply and price behavior. One mechanism is token burning. Some protocols permanently destroy a portion of tokens through fees, penalties, or scheduled burns. When done consistently and transparently, burns reduce total supply over time. However, their real impact depends on scale. A burn that looks impressive in percentage terms may still be insignificant relative to daily trading volume. Another major factor is staking and lockups. When tokens are staked or locked in smart contracts, they become temporarily unavailable for sale. This reduces liquid supply, sometimes dramatically. During periods of strong conviction, large portions of supply can be locked away, tightening the market and increasing sensitivity to demand shifts. But lockups are not permanent. They represent delayed supply, not destroyed supply. When lock periods end, or when yields fall, those tokens can quickly re-enter the market, expanding effective supply again. Then there is inactivity. A substantial portion of crypto supply hasn't moved in years. Coins may be lost, forgotten, or held by long-term participants with no intention to sell. From a market perspective, these coins are functionally removed from circulation, even though they still count toward total and circulating supply metrics. This is why two assets with the same circulating supply can behave very differently. If one has a large base of inactive or committed holders, its effective supply is smaller and less reactive to price changes. The critical insight is this: supply leaving the market doesn't have to be destroyed to matter. It just has to become unavailable. Burns, lockups, and inactivity all shrink the pool of tokens that can respond to price movements. that can amplify demand when it appears, but it can also reverse quickly when conditions change. Understanding this dynamic helps explain both sudden rallies and equally sudden reversals. How demand forms in practice, not theory. Now that we've separated what supply is from what supply does, it's time to look at demand the same way, through behavior, not assumptions. In practice, crypto demand does not come from a single group with a single motivation. It comes from different participants acting for different reasons, on different timelines. That diversity is exactly why demand can appear strong one moment and vanish the next. Start with retail participants. Retail demand is usually reactive. It tends to show up after price moves, headlines spread, or narratives gain traction. This demand is often aggressive but short-lived. It can push price quickly, especially in thin markets, but it is also the first to disappear when momentum slows or volatility increases. Then there are traders and speculators. Their demand is conditional by design. They buy breakouts, pullbacks, or specific technical setups. If those conditions fail, demand turns into supply almost instantly. This creates sharp transitions where buying pressure flips into selling pressure without any change in fundamentals. Next is institutional and professional demand. This demand is slower, more price-sensitive, and often less visible. Institutions rarely chase price. They scale into positions, use derivatives to manage exposure, and may pause entirely if liquidity is insufficient. When institutional demand is present, it stabilizes markets, but it rarely announces itself. There is also protocol-driven demand. Some demand comes from the need to use a token, paying fees, posting collateral, participating in governance, or accessing services. This type of demand is often overstated. Utility demand matters, but it usually operates in the background and grows gradually rather than driving sudden price moves. The most important point is this: demand is fragmented, conditional, and time-bound. Price moves not when everyone believes, but when enough participants decide to act at the same time, and when supply is thin enough to let those actions matter. Understanding who is buying, why they're buying, and how long that demand is likely to persist is far more important than measuring attention or sentiment alone. Liquidity, the missing piece. Most people ignore. Liquidity is the quiet force behind most crypto price movements, and it's the variable almost everyone overlooks. Liquidity is not volume, it's not market cap, it's not how popular an asset is. Liquidity is the market's ability to absorb trades without significantly moving price. In highly liquid markets, large buy or sell orders can be executed with minimal price impact. In low liquidity markets, even modest trades can push price sharply higher or lower. Crypto, as a whole, operates much closer to the second scenario than most people realize. This is why crypto prices can move dramatically without new money entering the ecosystem. If liquidity is thin, price doesn't need a wave of buyers. It just needs the absence of sellers. A few aggressive market orders can chew through the available sell orders, forcing price upward until new supply appears. The same dynamic works in reverse. When liquidity dries up on the bid side, price can fall quickly, even if long-term holders haven't changed their views. It's not panic. It's empty space in the order book. Liquidity also changes over time. During periods of optimism, more participants place limit orders, spreads tighten, and markets feel stable. During uncertainty or stress, liquidity providers pull back. Order books thin out, spreads widen. The market becomes fragile, more sensitive to every trade. This is why volatility often clusters. It's not just emotion, it's a structural withdrawal of liquidity. Another subtle point is where liquidity exists. Liquidity concentrated near the current price stabilizes markets. Liquidity far away does very little. If there's no depth close to price, even small demand imbalances can cause large moves before the market finds resistance. The key takeaway is this: liquidity determines how much demand or supply is required to move price, not conviction, not narratives, and not market cap. Once you start looking at crypto through the lens of liquidity, many mysterious price moves stop being mysterious at all. Price is set at the margin, why small trades matter. One of the most counterintuitive ideas in crypto markets is this: Price is not set by the average participant, it's set at the margin. That means the market price reflects the last trade that cleared, not the collective conviction of all holders, users, or believers. Millions of people can agree an asset is valuable, and price can still fall if the marginal buyer steps away. In an order book-based market, price moves when an incoming order consumes the nearest available liquidity. If there are very few sell orders close to the current price, even a relatively small buy can push price up several levels. Nothing fundamental changed. No mass adoption occurred. The market simply ran out of sellers at nearby prices. The same logic applies on the way down. If buy orders are thin or pulled entirely, a modest sell order can cascade through the book, pushing price lower until it finds demand willing to step in. That's why price drops often feel faster and more violent than rallies, not because fear is stronger than optimism, but because liquidity disappears asymmetrically. This is also why headlines like "billions wiped off market cap" are misleading. Market cap is a calculation based on the marginal price multiplied by total supply. It does not mean billions of dollars actually traded hands. In reality, price may have moved on a fraction of that amount. Understanding marginal pricing also explains why sideways markets can persist despite strong conviction. Breakouts can happen suddenly after long periods of quiet. Reversals can occur without warning or news. Price moves when the balance of immediate willingness to transact changes, not when long-term beliefs shift. This is a critical mental reset. Crypto markets are not voting machines where every opinion is counted. They are clearing mechanisms where the most urgent buyers and sellers at the edge of liquidity determine the outcome. Once you internalize that price is set at the margin, volatility stops looking irrational and starts looking inevitable in a market built on thin, dynamic liquidity.